Chris, the global economic crisis continues to drag on. What impact is that having on the industry?
From a demand point of view, if we look at that, there is always the fact that the pools of insured risk might shrink or contract. So if you take a class of business like, for example, employers' liability, that is very sensitive to employment and the size of payrolls. So if you have more people out of work, demand to the insurance companies for that type of product, that type of line will shrink. Equally, if you have companies going out of business, there's less to insure. If world trade is affected, there's less cargo being moved around. So again, there's a sort of a knock-on effect into the marine and to the cargo sectors. So there is an effect on demand. Now that can also affect the reinsurers, because as insurance companies try to control or maintain their margins, faced perhaps with reductions in premium income, one of the things that they will do is perhaps retain more risk on their balance sheet, so buy less reinsurance, or look at other ways of perhaps consolidating their reinsurance program, again reducing the potential reinsurance spend. The sovereign crisis, two factors there really. Will the effect of sovereign debt problems be an issue for balance sheets? And most companies have been open about their holdings of sovereign bonds from the distressed countries in the Mediterranean and Atlantic periphery. But we do not think, certainly in the reinsurance sector, that the exposure is a concern. And so from a supply point of view, we don't think it's a huge issue. And I think one other factor is just the impact on interest rates. And we have a lot of countries holding interest rates down. Investment income is normally the greater part of an insurer's or a reinsurer's earnings. So again, profitability, margins are under pressure from interest rates which are being held down by central banks.
Many in the industry are concerned about outside influences from regulators and solvency to catastrophe modelling firms. What are the issues to watch?
Well, those are all very interesting factors, particularly if you roll the rating agencies into it as well. And what are these organisations saying? Well, the catastrophe models, which are well embedded into reinsurance underwriting for cat perils, they are determining to a certain extent the amount of capital that might need to be allocated to a particular peril. You have the rating agencies saying that to run a business with this particular risk profile, you need a certain amount of capital. Oh, and by the way, we think that diversification is a good thing, so perhaps persuading people to move into lines of business which perhaps they might prefer not to or lack expertise in, but they're doing it in order to keep their capital costs down, and the regulator doing the same thing as well.
Guy Carpenter recently published the first industry risk benchmark report for loss ratios and reserves. What can this report tell us?
Well, the first thing I would say is that the report is based on US data, and that is because the US data is readily available and it is also uniform. So it's very easy to pull it together and to aggregate it and to analyse it. Nevertheless, it is aiming to set some loss ratio and performance benchmarks which we think will be of use. The research is still at an early stage. But what I would say is this, that it reinforces and provides some empirical evidence for the old adage that good years get better and bad years get worse. That is to say, those years in which we have seen redundant or surplus reserves being released, those years tend to improve, but years in which perhaps the original loss estimates were insufficient start to deteriorate and continue to deteriorate. But perhaps the most important conclusion when we look at the charts is that it suggests that the years of over-reserving which we have enjoyed really since Hurricane Katrina and which have been supporting earnings and profits appear to be coming to an end, and so we think there could be a turn in the reserving cycle. That support fading away, that could be a factor which might help to turn the market from its soft state to a harder state.